want to start with you, and this seems to be winning some support, let's call it, in terms of how it was structured, the delicacy with which they're trying to not bail out shareholders but protect depositors. Do you think this was a well-crafted rescue?
Look, I think this was a giant bailout. I'd been hoping that they'd been able to sell the assets in the customer bank of basis of the bank and not resort to essentially providing unlimited deposit insurance. The predicate of deposit insurance has always been about protecting the little guy and having sophisticated counterparties of banks bear some risk and have some market risk. So I was hoping for different news this morning.
So what do you think should have been done? I mean, in terms of protecting the little guy, people would argue, well, what about small businesses who have accounts over that cap?
Look, we're talking about a bank that had 97% uninsured deposits. We're talking whose biggest creditor seems to have been a $3 billion account with a cryptocurrency. And we're talking about a bank where all the insured depositors had already been taken care of. And so I think what we're doing here is risking a fundamental structural change to our regulatory system in a situation where you had a bank completely under the nose of the San Francisco Fed. Where was the supervision of this bank? People talk a lot about regulation and the rules. I'm asking the question about where were the supervisors as this bank quadrupled in size over a couple of years and blew up a giant unhedged interest rate risk tied to Fannie, Freddie, and U.S. Treasuries. How was this allowed to happen right under the nose of the San Francisco Fed?
Do you have any theories on that? And what about the piece of regulation, DoddFrank, that kind of enshrined the current financial system?
Yeah, look, Dodd-Frank regulates laws and rules. You can't regulate judgment. And I am completely bewildered and betwixt as to where the lack of regulatory judgment was and allowing this bank to pursue such an unusual funding model, entirely reliant on uninsured deposits, investing all of that money in low-yield mortgage-backed securities a year ago. It's like the Fed had no idea that interest rates were going to rise over the next year and allowing that to go unhedged. There's only so much you can legislate and regulate. It comes down to regulators doing their job. And in this case, I think the Federal Reserve failed to do its job.
So, Raghu, I'm curious what you would say about this, because to put it differently, this bank went from, I forget exactly the starting number, maybe 60 billion to 200 billion in deposits or something, because it was the recipient of such stimulus largesse, like many deposit institutions across the country. It has to make a NIM, it has to make a spread, so it turned around and invested that in what it thought was a relatively high-yielding option at the time. What should have been done differently?
Well, I am with Aaron. Clearly, it was taking enormous interest rate risk, right? Investing in long-term bonds while funding itself with overnight deposits. And clearly, the regulators should have been paying attention. It could have invested in short-term instruments. It wouldn't have taken on risk. It wouldn't have made much money.
Exactly. It wouldn't have made any. I mean, the fundamentals of banking is to capture that spread. There was the same idea that there is no alternative, that people couldn't get income anywhere. Well, banks had the same problem, so they were forced to get it wherever they could. That was the only what else were they supposed to put that cash in?
Yeah, this is the search for yield problem, right? When the Fed pumps the system full of liquidity, but at the same time, interest rates are so low that they can't make much money, what they do end up taking is more risk. And that's where the supervisors have to be more active, trying to look at what banks are doing. Clearly, as Aaron says, a bank which is funded with 93% wholesale deposits, which are very runnable, and investing it in long-term bonds when the Fed is going to raise interest rates. I mean, that should be red flag, red flag, red flag after red flag for the regulators.
David, let me bring you in here, sort of broaden it out and put this in context. I saw you nodding along as we're having this discussion. Do you favor what the government did here? Do you think that this was the right move both for the public and for the markets?
Similar to so much of what happened after 2008, I don't think the major issue is what they did today. It's all the things that built up to making today necessary. I agree with everything both of the prior guests said. I cannot believe the president dared to say, well, we just need more regulation. We're going to get more regulation to keep this from happening again. I thought they already did that. As a matter of fact, they promised the American people they did. This is such a failure of competence that I can't believe people put up with it. And the one thing I'll add that the other two guests didn't get into is the Fed's culpability, not merely as the regulatory overseer, but as the setter of monetary policy. That easy monetary policy that they left on way too long after the COVID emergency is what enabled that deposit base to go up so much. All the silly IPOs and SPACs and the shiny objects, that ridiculous crypto story, that's how that deposit base came up. And then they over-tightened and they destroyed value on the way down.